The stock market is one of the most powerful wealth-building machines in human history. It has helped ordinary people retire comfortably, turned small savings into fortunes, and even created billionaires who rank among the richest individuals in the world. But how exactly does this system work? And why does it have such an enormous impact on our daily lives, even if we never buy a single share ourselves? To answer that, let's go back to the beginning. The story begins in the early 1600s with the Dutch East India Company, or VOC. At that time, trade between Europe and Asia was risky and incredibly expensive. Ships had to travel thousands of miles, face dangerous storms, and guard against pirates. Financing these long voyages required enormous sums of money. Instead of asking a single wealthy person to fund each trip, the VOC tried something revolutionary. It sold shares of ownership to many different investors. Those investors would receive a portion of the profits once the ships returned with valuable goods like spices, silk, and porcelain. For the first time in history, people could buy a piece of a company without having to run the business themselves. And they could also sell that piece to someone else whenever they wanted. The Amsterdam Stock Exchange was created in 1602 to handle the buying and selling of VOC shares. Generally agree, this was the birth of the modern stock market. This model spread across Europe. In London, coffee houses became early hubs for share trading, eventually giving rise to the London Stock Exchange. Over the centuries, more and more companies began raising money by selling shares to the public. The principle was simple but powerful. Companies get the money they need to grow, and investors share in the profits if the business succeeds. At its core, a stock is a small unit of ownership in a company. When you buy a stock, you're not just purchasing a slip of paper or a number in a trading app. You're buying a stake in that company's future. If the business does well, growing sales, earning profits, and expanding into new markets, its value usually rises. And so does the value of your stock. If the business struggles, the opposite happens. This is why stocks are sometimes called equities. They represent an equity or ownership in a company, and that ownership comes with certain rights. Shareholders can vote on major company decisions, receive dividends, a share of profits paid out, and benefit if the company's share price climbs. But how do stocks actually get from a company into the hands of investors? That's where the initial public offering, or IPO, comes in. When a company wants to raise a large amount of money, for example, to build new factories, expand internationally, or develop new technology, it may decide to go public. This means it sells shares to the general public for the first time. The process usually works like this. The company hires investment banks to act as underwriters. These banks value the business, set an initial price for its shares, and then offer them to big investors like pension funds, insurance companies, and hedge funds. Once those shares are sold, the company officially becomes a public company, and its stock begins trading on an exchange like the New York Stock Exchange, Nasdaq, or the London Stock Exchange. From that moment on, anyone from billion-dollar funds to everyday investors with a smartphone app can buy and sell those shares. Stock prices aren't fixed. They rise and fall based on supply and demand. If more people want to buy a stock than sell it, the price goes up. If more people want to sell than buy, the price goes down. But what makes people want to buy or sell in the first place? Company performance, strong earnings reports, new products, or good leadership can attract buyers. Poor results or scandals can push them away. The economy, inflation, interest rates, and global trade all affect investor confidence. News and sentiment. A single headline about a lawsuit regulation or takeover can shift prices dramatically. Market psychology. Sometimes people buy because others are buying or sell because others are selling. Fear and greed are powerful forces. This constant tug-of-war between buyers and sellers makes the stock market one of the most dynamic and unpredictable systems in the world. There are two main ways investors make money from stocks. Capital gains. If you buy a stock at £10, about $13 or €12, and sell it later for £20, about $26 or €24, you've doubled your money. This is the most common way people build wealth in the market: dividends. Many established companies pay shareholders a portion of their profits every quarter. These payments can provide steady income, especially for retirees. Some investors focus on growth stocks, hoping for big price increases. Others focus on dividend stocks, preferring stable long-term returns. And many combine both strategies. Of course, the potential for profit comes with risk. Not every company succeeds. Some collapse entirely, leaving shareholders with nothing. Markets themselves can also swing wildly. The Great Depression of the 1930s, the dot-com crash in the early 2000s, and the 2008 financial crisis all wiped out trillions of dollars of investor wealth in short periods. That's why financial advisors constantly remind people to diversify, spreading investments across many different companies, industries, and even countries. Diversification reduces the chance that one bad bet will destroy your savings. The stock market is more than just a place where people try to get rich. It's also a critical engine of the global economy. For companies, selling shares provides the capital they need to innovate, hire workers, and expand. For governments, healthy markets encourage investment, create jobs, and generate tax revenue. For individuals, stock ownership has become a key part of retirement planning. Pension funds and 401k plans rely heavily on stock investments to grow over decades. When stock markets rise, confidence spreads throughout the economy. People spend more, companies invest more, and growth accelerates. When markets crash, the opposite happens. Confidence falls, businesses cut back, and recessions often follow. The stock market has not only helped millions of ordinary people grow their savings, it has also created some of the richest people in history. Warren Buffett, once a boy delivering newspapers in Omaha, became one of the world's wealthiest men by carefully buying stocks in undervalued companies. Elon Musk, Jeff Bezos, and Mark Zuckerberg saw their fortunes explode as the stock prices of Tesla, Amazon, and Meta soared. Countless smaller investors have become millionaires by steadily investing over decades. This illustrates one of the most important truths about the stock market. You don't need to start wealthy to benefit from it. A small but consistent investment held patiently over years can turn into life-changing sums. For most of history, the stock market was dominated by professionals, wealthy individuals, bankers, and large institutions. Ordinary people had limited access. That changed with technology. The internet, online brokerages, and smartphone apps have opened the market to anyone with a few pounds or dollars to spare. Today, you can buy a share of Apple or Coca-Cola with a few taps on your phone. This democratization of investing has created new opportunities, but also new risks. Easy access means it's also easier for inexperienced investors to chase trends, panic sell, or get caught in hype cycles. Education has never been more important. One of the hardest parts of investing isn't technical, it's emotional. When stocks are rising, people feel euphoric. This time it's different, they tell themselves, and they rush to buy at high prices. When stocks fall, fear takes over. Investors sell at the bottom to stop the pain, often locking in losses. This cycle of fear and greed is as old as markets themselves. It's why legendary investors like Warren Buffett famously say, "Be fearful when others are greedy, and greedy when others are fearful." The key lesson is that markets move in cycles. What goes up can come down, but over the long run, history shows that stock markets tend to rise as economies grow. For most people, the stock market shouldn't be about chasing quick riches. It's about building wealth slowly and steadily. Consider this. Historically, the US stock market has delivered an average annual return of around 7 to 10% after inflation. That may not sound like much, but thanks to the power of compound interest, it adds up. Investing about £500, about $650 or €600 a month, at a 7% return for 30 years grows to over £600,000, about $780,000 or €720,000. At 10%, the same £500 $650 or €600 a month grows to nearly £1.1 million, about $1.4 million or 1.3 million euros. This is why financial advisors stress patience, discipline, and consistency. The stock market rewards those who stay the course. Looking ahead, the stock market will continue to evolve. New technologies like artificial intelligence, blockchain, and algorithmic trading are already reshaping how markets operate. Companies from emerging industries, renewable energy, biotechnology, space exploration, could create the next generation of millionaires and billionaires. At the same time, challenges remain. Geopolitical tensions, climate change, and government regulations can all influence markets in unpredictable ways. Investors will need to stay informed, flexible, and prepared for volatility. The stock market may seem intimidating, but at its core, it's simply a marketplace where companies and investors meet. Companies raise money to grow. Investors buy shares to participate in that growth. Prices rise and fall with confidence, performance, and global events. Yes, people have lost fortunes in the stock market, but millions more have built financial security, and some have even risen to billionaire status. The key difference lies in education, discipline, and a long-term mindset. So, whether you're an ordinary saver hoping to grow your retirement fund or an ambitious entrepreneur dreaming of building the next global giant, the stock market remains one of the most powerful tools available.